There are many different approaches to managing vertical income spreads. We can't tell you which technique is best for you, but we can introduce you to multiple management techniques and the pros and cons of each approach so that you can make an educated decision about what style you want to start with. The most important rule in trade management is to remember that no matter what rules you have set up, unexpected things can happen, and you should always position size as though you could lose the entire amount you have at risk in a trade. Since vertical spreads are a limited loss, limited reward type of trade, management rules should be straightforward and simple. There are 3 exit points that you need to have rules for: an exit for a loss, an exit for a profit, and a time-based exit. Let's talk about loss management first. There are 2 basic approaches to loss management that we're going to introduce you to here. The first is to just simply risk it all. The benefits of simply risking it all are that you don't have to worry about the emotional side of the loss-taking process, and even if the trade goes against you, you can stick it out to see if it'll come back. There's no wondering whether it's time to take a loss or not. Because you started the trade by saying you're willing to risk it all, you can just let it go to maximum loss if you so choose. Now, keep in mind that just because you said you're willing to risk it all, you don't have to risk it all. If at any point during the trade it becomes clear that the trade is not going to be successful, you could just exit the trade, preserve whatever funds you have left, and redeploy those funds elsewhere. The downside to just risking it all is that it can lead to a single losing trade completely wiping out a lot of winning trades. For example, if your typical trade has a return on risk of 25%, that means you're risking $4 to try to make $1. One losing trade in that scenario could wipe out the profits from 4 winning trades. You'd have to have an 80% success rate just to break even. The second approach to loss management that we want to introduce you to is based on the strike that you sell. For a vertical income spread to be successful, the stock has to stay on the correct side of the option strike you sold. For example, if you placed a bull put spread with a sold strike of $50, the stock needs to stay above $50 for the trade to reach maximum profitability. In the sold strike technique, we simply set a rule that states if the stock closes outside of my sold strike, I'll exit the trade for a loss. So in our example, if the stock closed below $50, we would exit immediately. There are 2 key benefits to this approach. First, the probability of losing the maximum amount on a trade is much smaller than the risk it all approach. Second, you're following your original analysis of the stock you are trading, and you're allowing yourself to admit that the trade is a loser. This enables you to free up capital from a losing position and again redeploy it elsewhere. There are a couple of downsides to this approach. First, you don't know exactly how much you'll be losing if the stock crosses your sold strike. There are way too many variables in option pricing to accurately forecast that. The second is that, of course, there might be a chance that the stock could come back. But remember, your primary concern as a trader should be controlling your risk first and foremost. After all, it's pretty hard to generate profits if you run out of money to invest with. What about managing profitable trades? There are a few approaches to this, and there's a couple that we'd like to introduce you to. One common approach, especially by newer investors, is to simply let profitable trades expire worthless. Well, this sounds good, in theory, because you collect 100% of the premium you received, and you don't have to worry about commissions or fees when you're exiting. This approach is mathematically flawed, however, and if you practice it too long, you're likely to end up losing more money than you make. The problem comes in the twin forms of diminishing return on risk and increased exposure to maximum loss potential. To put it simply, the closer you get to expiration, the higher the chance of experiencing maximum loss in the trade. The diminishing return on risk is worth going into further here. It explains part of the reason for not holding a trade through expiration. We'll use one of our trades from the Constructing Bullish Vertical Spreads video to illustrate the concept of a diminishing return on risk. In that video, we built a trade on a $300 stock. It was a 27-day vertical spread. The total profit potential on that trade was $133 with a risk of $367. That's a 36.23% return on risk. Let's say that 7 days later the trade was showing a profit of $110. That means the trade was already showing a profit equal to 82.7% of its maximum profit potential. That also means that the trade still had another $23 that could still be realized. The big question here is, how much are we risking by staying in the trade? The trade originally had a risk of $367. Our risk of staying in this position now has increased to $477. Why? Because not only are we risking our original $367, but we're also risking our unrealized profit of $110. So mathematically, we're now risking $477 to make $23. With 20 days remaining, the return on risk in the trade is down to under 5%. This diminishing return on risk, along with gamma risk, is why many experienced traders plan on exiting vertical spreads prior to expiration. One popular approach to setting a profit target is to select a consistent percentage. For example, many traders try to target 80% of maximum profit before exiting. Some traders prefer to get out quicker and set a lower profit target, such as 50% of the maximum profit. Another variation of this technique is using a tiered approach to exiting. For example, you could divide a trade into 4 time periods or quadrants. For a 1-month trade, that would mean 1 week is 1 time period. After 1 week, if you had profited 50% or more, you'd exit. After 2 weeks, exit at 65% or more. After 3 weeks, target 80%. This approach takes into consideration not only how much money you could make, but also the time frame over which it could be made. At this point, we've covered a few different approaches to managing a losing trade, as well as a couple of approaches to managing a winning trade. Now we need to cover a time-based exit strategy. We already talked about the principle of diminishing returns, as well as increasing gamma, and how those make holding trades through expiration a risky idea at best. It's a good idea to consider minimizing these risks by setting a deadline for exiting a trade no matter what. A common approach would be to exit 2 or 3 days prior to expiration at the latest. This dramatically minimizes the likelihood of maximum loss in a vertical spread, as well as decreasing the probability of getting exercised. Always remember that anytime you sell an option, it's possible for you to get exercised. Not holding through expiration greatly diminishes that risk, but it doesn't eliminate it entirely. In the event of an early exercise, don't forget you can exercise your long option to cover your risk if you need to. If you hold through expiration and your sold option gets exercised, you're liable for the risk of the stock position. If you have any questions about exercise risk, don't hesitate to contact your broker for help. Now that we've introduced some income vertical management techniques to you, write some rules down, paper trade with them, experiment, make sure they work for you, and adjust them as necessary before implementing them with real money.